Welcome to the Expert Exchange, the podcast where knowledge meets success. I'm your host, Josh Carnes, and on today's show, we're going to be talking about what business owners need to know before they exit. Joining me on today's show is Mike McNamee with Dedicated Wealth Partners of Raymond James. Mike, thanks for coming on.
Thanks for having me.
And sitting next to him is Mari Ramirez with Open Bookkeepers and Mari Ramirez CPA. Mari, thanks for coming out today.
Thanks for having me.
At Lion Business Advisors, selling a business is not just a transaction. You've poured your heart and soul into your business. It's not just a paycheck, it's your legacy. The team at Lion Business Advisors is here to guide you through the process, ensuring your successful exit. Contact the team at Lion Business Advisors at 800-525-3542. That's 800-525-3542, or visit us at lionbusinessadvisors.com. Lion Business Advisors. Let the story of your next chapter begin with us.
I would like both of you to just take a moment, introduce yourselves, tell us about yourselves, your company, and how can a high level of what you do in the exit process. So, Maury, let's start with you.
Sure. I'm a CPA that I've been doing this for about 20 years. My firm has been open for about 10 years. We do tax planning, CFO services. We do bookkeeping and monthly bookkeeping, and a whole range of other things, including helping people sell their businesses.
Yeah, and we can speak from experience with that. Maria has sent a few clients our way that have ended up exiting, and just the process of how you guys manage those clients, and from a tax perspective, it has been wonderful and helped those clients exit. So super excited to have you
Yeah,
on.
thank you.
And Mike, tell us about yourself.
So I'm a certified financial planner with Dedicated Wealth Partners of Raymond James. We specifically help business owners with the complex financial planning that goes into planning to sell, and then also the legacy planning that happens after the transaction.
Perfect. And then you also became a certified exit planner, correct?
I did, yes. Also a certified exit planner along with my partner down in Coral Gables. The big thing there with the exit planning, which we'll get into later, is just talking about helping owners build out their team to increase the success of them exiting their business.
Nice. Yeah. Perfect. So also light plug. If you're in the Austin area, Mike and I happen to run the Austin chapter of the Alliance of Mergers and Acquisitions Advisors. We would love to have you out at an event, buy you a drink, or do anything like that, and ask any questions. So it's a fun time. Perfect. So let's dive into it. So I had you both on today because we really wanted to dive into the topic of what business owners should know before they exit. We all get the call of, hey, I'm looking to exit. It's already too late. They're going in. What do they need to do? So let's dive into it. What are some of the top things that you think business owners should know before they exit?
Well, I think before they exit, it's interesting because I feel like it's a few times a year for me where a client comes to me and says, I think I'm ready to start talking about selling my business and just start planning for future. And it's always like, okay, let's go. I feel like this is the time, but really it's the best time to do it is when you're doing really well and it's an upward trend. And it's almost like the hardest time to let it go because you're doing so good. You have efficiencies in place. Staffing is great. There's a lot of demand for what you are doing. And so it's almost a little bit harder, but you've got to, what is it? Buy low, sell high.
Yeah.
And so a lot of times they're coming to me because they're like, should I sell? Because I'm doing really well. And I'm like, yeah, this is the best time to do it. So it's like, can I go higher than this? And I think that's where people get into trouble. They're like, can I go more than this? Or is this the high? Will it go down from here? And so I think starting to plan that in the beginning of like, yeah, let's do it now. Because I think if you are doing really well and you have everything in place, that's really the time to be selling. And then sometimes when I see a client and they're my client and I'm doing it monthly, I'm like, this is a really great time to sell. I start putting it in their brain and they're like, yeah, but it's going really well. We have all these efficiencies and we're doing so good. And I think we can increase. And I'm like, yeah, but this is a good time. I think that's where the harder conversation is. But if you're not having anyone look at it or you're not thinking about it, then it's a bit harder to get someone in.
Well, and I think that's where just having strategic people who can talk, because the reality is buyers want to buy great businesses that still have an upside. Right. And so it's hard to know when that peak actually is.
Right.
But Mike, where do you come in on the exit strategy?
Well, there's two things we look at. So we always like to meet people a few years before they exit. So we kind of help them with that process. But, the first thing we always ask is, who's your team? So who's your M&A advisor? Who's your CPA? Who's your estate attorney? And making sure that that is taken care of first. If they don't have those individuals, we'll introduce them to those professionals. The second thing we go into is what is the wealth gap? And that essentially is taking a look at, well, what's your number that you need to retire comfortably and set your family up for success? Where are you right now, excluding the value of your business? And then that gap in between is probably the value that we're going to try and harvest out of your business as you prepare to exit to help close that gap. And a lot of people don't think of it that way. And then from there, we address the three legs of the stool, which is the personal, the business, and the financial. And that's where everyone has the business side down. Maybe they have the financial side down, but the personal side, they haven't even thought about.
No, that's true. But it's funny because when I get into it and I'm like, let's sell your business. I'm like, it's like balls to the wall. We're like 100 miles an hour. I'm like, Josh, let's do. It's like very fast paced in that sense. So I feel like I'm always at the very end. It's not like 1 or 2 years. Sometimes it's a much shorter range. I mean, I think it might be 1 to 2 years once it's closed, but just the starting of the process to do it, I feel like is a lot more fast because we have to get things ready and get things in place. But that would be great if it was that early in advance. But nobody ever thinks about the personal side for sure.
No, and so you threw a bunch of stuff out. We're going to dive into a lot of those topics, but I think you hit on one of the things is it truly takes a team to close a transaction at another level, right? We see so many business owners who are like, I sold my first business I did on my own, and you kind of ask them the numbers. It wasn't great. It was small. They regret it, things like that. If you actually take the time to plan and put a strategic team in place, and it's more than the three of us sitting here. You have to have an estate plan attorney, an actual business transaction attorney. It can't be your brother-in-law who does DUIs or anything like that, right? You have to put a plan in place. But the clients that actually do that and take those practices, they end up selling for much more and get much higher multiples. So that's what we're going to try to dive into today and see if we can squeeze as much information out of the two of you as possible to help people exit for maximum value. How important is it for business owners to understand their financials for both an exit place and, I think you kind of hit on it, the post-exit? So where do financials?
So I have kind of a hot take on this in the sense of, I think you need to understand it, but not perfectly. Because I think people get wrapped up in the details of like, what does this mean? What does this mean? And I'm like, listen, you're doing well. That's what you need to know. Or this is how much you're profitable. This is the summary of what you need to know. People get wrapped up in really small details that are not that important. Now, then again, there's the other side where people are like, I don't know and I don't care. So there's some place in the middle where you're like, you got to know some. I think you have to have an understanding of it, but it doesn't have to be perfect. Let the financial advisors and the CPA tell you this is how it's going and this is what's happening and this is the summary and this is really what you need to know. Because I think people get wrapped up in the details and they get too caught up on it having perfectly, or the opposite, they don't have anything. So it's like, it's somewhere in the middle, not too much, not too little. Obviously, if you have a background of financial, great, so you understand that. But I think a lot of people that are running their businesses, they're doing what they love to do and they're doing what they're good at, but they're not really paying attention to the financial side. So I think there needs to be some help there to just kind of understand where they're at, and kind of have some kind of versed in it, but it doesn't have to be perfect.
Yeah, what we tell business owners is you're an expert at doing what you do. Now have those experts that come around. And so, I mean, we'll get into business valuations, but, businesses sell in a range. They sell for a low end and a high end. And clean financials absolutely move you up the needle to get that higher multiple. We have a client right now that they are still keeping track of their clients on a calendar on their desk and invoicing like that. And so we've been working with them now for 1.5 years to transition everything over to some sort of accounting system. So having that stuff in place, it's kind of crazy to me. It's a pretty simple one, but it's a huge piece that will move the needle for buyers buying businesses. So where do financials come in for you, Mike?
So I always tell people we're the organizer, right? So we're helping you're putting your personal financial statement together. We're putting all the bank accounts together, the investment statements, And then what we're also doing is asking you questions about your balance sheet, make sure you clean that up, right? So taking the personal expenses out of it that don't necessarily belong there, and just really looking at certain ways that you can improve it. And then from there, we're the quarterback to the team in the essence of we will work with the other advisors on your deal team.
Mhm.
So that way we're all able cohesively to work together and to put this together. And especially from a business valuation standpoint, there's a big advantage to us just putting everything together and sending it over versus the client who's running the business and trying to do all this stuff all at one time. When we're able to remove them, let them focus on the business while we focus on everything else, they really appreciate that.
When should a business owner tell their CPA, tell their financial advisor that they're going to sell? We were talking about it before we hopped on the show, but CPA is generally the first one to know.
I think
so when,
right away. I think right away.
away.
I mean, CPA and your financial advisor are kind of like your lawyers. I mean, they're not your lawyers, but it's not like they're not allowed to really go send that information or tell that information to other people.
Yeah.
Whether or not you tell them, don't tell anyone. They really shouldn't tell anyone.
Yeah.
That's a really big problem that they do. But generally speaking, that should be the first people you tell. It's happened before where someone's like, I'm thinking about selling a business, or someone came up to me to buy the business, they're after the fact.
Mm-hmm.
But usually it's in that process that's happening. The sooner, the better. So you can make sure everything's clean or have everything together. I wouldn't see why you wouldn't say that.
Yeah. Mike, you hit on this one earlier, and as an M&A advisor, we leverage financial advisors like yourself all the time because we think it's really important. A client will come in and say, I need 10 million to walk away. Mm-hmm. And we ask them, we're like, all right, so where'd you get that number and what does that mean?
Right.
And so when should they be talking to their financial advisor to get a realistic number?
Yeah, that's where the financial planning comes in, right? And that's the wealth gap that we spoke about. If you need 10 million, but you only have 2 million liquid, the 8 million just isn't going to pop up out of nowhere. So, I mean, we're doing a financial plan. We're taking a look at everything from the estate planning to insurance to your investment assets. And then we're putting it all together. And a lot of times that gap, we take a look, and that's where you need to unlock that value in your business. And then we need to see if it's realistic, because not all the time is that realistic depending on what you're spending. Mm-hmm. So we have to make sure that the plan works. And then we have to, from there, set up a plan to help you build your business to exit at that possible number and then see if it's possible. Mm-hmm. And it usually comes with a lot of hard conversations. Owners have a very specific vision of what their retirement is going to look like and what their legacy looks like. And they may talk to their spouse about it, or they may not, and they'll talk to you. But then what we always go back to is like, okay, you have this all put together. Now go talk to your kids about it and see if that's what they also think. Because if you have this whole plan on how you want things to move, and then, what your kids are going to do, this and that, and then you realize that the kids don't want to do any of that, then it totally changes everything.
Right.
So it's about having those hard conversations. And just that's the personal side that no one ever really thinks about.
Well, I think the other thing is also sometimes there's no kids and they're just making decisions on their own. And it's more about what the next project is going to be. So they're not necessarily thinking about retiring. They're like, we're going to get this money and start a whole new other project. And so I think it's also, because that's fair. It depends on where you're at in your life.
Right.
And I've run across other tech people that are just like, they're just ready to sell this business to start the next idea they've got going on.
Right.
And I think that's interesting because they already kind of have in mind what they need to do that next project. So they can just start up that situation. And it's always different, right? It's like when you're just like retiring versus starting a next project, it's always it's interesting because it's a different amount of money they want. And sometimes those people are a lot higher, sometimes it's lower. And so I think just deciding what that looks like and where you need to be, and then figuring out the discrepancy there.
Yeah. I think you hit on something. Exit planning and succession planning are really two different things. And the numbers of second generation and third generation family run businesses are declining at crazy rates. And it's, you feel bad when you talk to a business owner who worked for 30, 40 years and they're like, well, my plan was to give it to the kids and they're not interested. So
absolutely.
That's another piece that we haven't hit on. But if you are planning to hand it off to your kids, talk to your kids about it and make sure they want it, because it is a completely different transition to go to a buyer than it is to the kids. You don't need to be worried about profit margins and things like that to hand off to the kids. They can focus on that. But if you're going to a buyer, different aspects become important. So that's a huge one that you hit on that we didn't really have. So,
and I'm going to use my little cheat sheet here, but I mean, let's just talk about some of the stats, because we talk about exit planning like it's just, okay, I'm ready to sell and you're going to get it, right? So 70 to 80% of businesses that go to market fail.
Yeah.
And Josh, I'm sure you could speak on it more because you even have more of that information.
Yeah, it's crazy. So businesses that are valued over $1 million actually only average about a 20% success rate in their first 12 months trying to exit. If you go to those family-run businesses under $1 million, Biz by Sell actually just put out stats for the last 4 years. So post-COVID, we have stats. It is less than 10% of businesses under $1 million actually sell within the first year.
Oh, wow.
It's horrific to go to market, and it's generally because they have not strategized and planned. It's that last minute phone call of, I'm selling, I'm exiting, I want out, how quick can we get this done? And it's not a quick process.
Don't have a plan in place, right?
They don't have their financials cleaned up. They haven't talked to a financial advisor. They don't know how much money they actually need, or whatever, 100 different reasons, but they're not prepared to actually exit.
And that leads into the next stat. So 78% of people have no formal transition team, right? Yet 68% of them have reached out to people to try and start a transition team.
Well, I think people think it's easy. Sometimes they're like, I can just sell my business. I have a business. Let's just sell it. Which it can be if you have everything kind of in order and you've been planning it for a while. But I think people jump ahead too quickly. So I think that's probably why the stats are so high. Yeah. Because people jump ahead against.
Well, that, and it's, our most closely related industry is real estate. And people, look at real estate agents, they stick a sign in the yard, they hold an open house, and they sell house. No offense to any real estate agents out there. We love y'all. But, they stick a sign in the yard, they hold an open house, they put it on an MLS system. Yeah. People show up and they put in offers and they sell it. And we've had it great in the real estate recently. Now, valuations have been great in business sales lately as well. And we've had some really good times, but the reality is it's done confidentially. Right. There's no MLS system. There's no open houses. There's no, we don't put signs in windows and things like that. So it's a completely different process. And they think, oh, it's super easy to sell my house. I just call a real estate agent. Boom, they get it sold. And they don't realize, average transaction time post-COVID is still 9 months. Wow. That's a great deal, is 9 months from the time you go, I'm going to sell and engage someone, to the time I actually get that check and move on.
That's actually a pretty good turnaround, I think. 9 months.
Yeah. Yeah. I mean, that's the average. Some stuff is closing in about 6 months right now.
Good.
It all depends on buyer and seller and how clean the business is.
Right.
The cleaner the business is and more prepared, you can get in and out in 4 to 6 months. It's great.
Yeah, I feel like the longest part of the whole transition is just getting everything in order and just due diligence. I think that's the longest time.
No, we tell people, so it takes about 3 months of actual prep work on our side of getting the business ready to be marketed, about 3 months of marketing the business to buyers, and then it's another 3 to 4 months of diligence and closing. And so, boom, you're at 9 months plus right there, just a standard process.
And they think, there's so many questions to ask too, right? So we clean up the financials and everything, but okay, who are your suppliers? Right? If you have one supplier, like we had a client, his only supplier was China. It's like, okay, well that could potentially be an issue, right? It's your employees, like who's your salesman? And a lot of times the CEO is like, well, I'm the number one salesman.
Right.
We're like, well, that's a problem too, because if you're exiting, then you don't have a sales team.
That's probably one of the biggest mistakes you can make for sure. Yeah. If you're like the key person, that's the harder transition.
And what's really interesting right now is, so you'll hear all the social media stuff talking about the baby boomer exodus or the silver tsunami and all these things. Well, everyone thinks, oh, that's going to be great for everybody's industry. But the reality is 80% of businesses in the US are valued at under $1 million. And it's because that owner is the business. It's been a great business. It put 150, 250 grand in their pocket. It put kids through college. It did all of that, but it was the owner, operator, function, and you have to remove yourself as the owner if you want it to be sellable.
And this is why you should have a really good team in place
Mm-hmm.
when that's about to happen. A good manager to kind of make sure that everything is that's your backup person.
Yeah.
Always have a backup person for yourself, because once you're gone, that manager is going to be really important. And most of the time buyers like that, right?
Yeah.
Someone's still there that knows everything.
One of the big things that we're seeing now is that number two is actually getting ownership interest from the new owners that are coming in, and they're saying, hey, we need you to stay on and we want you vested long term. So
yeah, and there's, you mentioned like the silver tsunami, it's 75% of business owners plan on exiting within the next 10 years.
mm-hmm.
And that's that baby boomer generation that we spoke about. So to get back to when do you start planning for it, you start now.
Yeah. The other thing too is if you are that owner operator, I think all three of us have connections to coaches and consultants that specialize in helping you remove yourself from that owner operator situation, placing a manager, placing a sales manager, whatever it might be. So
Absolutely.
Feel free to reach out to any one of us. We'll put you in connections with someone who can actually help you take that next step of, it's been a great business that's provided for me, but now we need to do something that's sellable.
Right.
Absolutely.
Now, it's also interesting, though, because of the we hit in on this, and you know, I'm working on some technology stuff that, because of the social media people that are out there, there are actually people buying these $200,000, $300,000 businesses today.
For sure.
And it surprises me all the time of what actually sells and what doesn't sell.
Well, because I feel like a lot of content's being out there of like, here's some passive income by these smaller businesses.
Yep.
And it's interesting because that push I've seen people being like, you know what, someone came to me and they want to buy my business. And I'm like, it's so small. It's so interesting because that's a new thing that people are just doing.
That passion project.
Yeah.
People are like, no, I love it. I absolutely want to be a part of this.
Right.
And then there's also those industries that just turn. So it's pretty interesting, but bars and restaurants turn every 4 to 6 years, new owners. So let's talk about business valuations, right? So we're trying to tell owners, get prepared to sell. How does a business owner come to a CPA or financial advisor? How do you go about the process of saying, here's what your business could sell for?
Oh gosh, that's a hard one, because with business valuation so important, it's kind of like, make sure everything's cleaned up. Obviously, if I'm around and I'm doing it, I feel like it's already clean. It's when someone comes to me and they do it on their own, I'm like, I got to get this cleaned up for you. I don't like seeing a lot of personal expenses in there, because obviously that might be deductions, but that doesn't look great for valuation. So you're just cleaning it up and make sure things are done correctly. But, obviously it's a lot of cash flow, a lot of, assets and liabilities, what's going on the balance sheet. And that's important on the in the business valuation. So I always kind of say, this is where you're at based on your valuation. You could use 3 different methods, and this might be the range. But
I think you hit on the different methods. So I think it's really important for business owners to know there are several different methods, and the why you're getting a business valuation can actually change the number of the business valuation.
Right. And it's so funny because you can use all 3 of those valuations and have a range between this number to this number. And then they sell for a completely different number, outside, under, or over, or whatever, which is always interesting. It's not perfect. It's never perfect.
So we always tell our owners too, businesses sell in a range, and those range will vary widely depending on your industry, depending on what you're doing.
Right.
If your business is cash flowing under $1 million, there's a range. Over $1 million, there's a range. Over $5 million, there's a range. And it is interesting. For our larger clients, we will actually go to market with no asking price. And we say, hey, here's the range we think we're going to play in. We have a client right now. They just accepted an offer for $14.4 million. Every buyer looked at the information that came back. We had letters of intent that went all the way up to $16 million and as low as $8 million. Every buyer had the same information. It's the same business.
So
everybody looked at it.
So different.
And it's also important that we tell our clients, and this is where a financial advisor comes into play, is you need to look at the offer in its entirety. They didn't go with the highest top line offer. That offer had them with a 40% seller carryback. It had a 10% seller carry note, all sorts of other things, but it was a higher number. So they could have walked away and told their friend, oh, we sold for $16 million, but after getting with their financial advisor, it's like, that's not what's going to work best long term. So
that's why it's important to have those people in place just to look those. Otherwise, how would you know? You just pick the highest one without really knowing the details of how that's going to work.
That's we tell people, look, 10 million all cash is not the same as 10 million 100% seller financing.
Nope.
Right. Now, one of the biggest things that we find interesting is seller financing is actually really attractive today, right? So rates are up in the 10%. All of a sudden, you throw 100,000 or $1 million, whatever that number is, in seller financing over 10 years, and you tax deferral, interest, all of that. It's a great seller financing can be a great opportunity for the sellers. So,
and people, they forget about it. So let's say, okay, I'm gonna 10 million cash. I'm always like, okay, well, it's not what you make, it's what you keep.
Yep.
So how much is that is subject to taxes? Do we have any loss carry forwards that we can use? Are we charitably inclined? What, how are we moving this money around and strategically planning to where you're keeping as much of it as possible? And how does that work into your financial plan?
Yeah.
And from a high level, we can address those issues. But then when it comes into the taxes and all that, then we have to get on the phone with Madi, right?
Yeah.
There's all those different ways that comes in. And then is that net number, does that address the gap that you have in your plan?
Yeah.
Right.
And a lot of people, they forget, they just see the number. But I mean, we just had a client 6 months ago, his deal fell apart because the way it was taxed changed from the private equity firm. So he went from netting 4 million to 2 million. And he was like, this doesn't work for me. It didn't address the gap in his business. He wasn't going to take it. The deal fell apart. From that.
We try to tell people all the time, it doesn't matter what the actual number is.
Yeah.
What are you walking away with?
Right.
And does it fit your lifestyle wants and needs moving forward? If it makes sense, it makes sense. If it doesn't, it doesn't. So I think it rolls great into the next kind of area of tax implications, right? In our industry, we call it a wealth event. And I think it's probably one of the biggest areas that we personally see smaller Main Street businesses, which are, mom and pop and doing it for 30, 40 years. They miss this and they don't understand the tax implications of getting $1 million in their pocket overnight. So what are some of the biggest tax implications that sellers should look out for?
Oh gosh. So it depends on if it's a stock sale or an asset sale. So that's a huge two differences. It's always better to do an asset sale if you can. That makes it better. It's better for the buyer. They're more inclined to do it as an asset sale. Not that it's honestly better for the seller to do it as a stock sale just because it's a capital gain. You have a basis there. It's a lot easier.
We also tell people, not to cut you off,
Go ahead.
sorry, but
no,
we tell people the reality is, just the cleanest way to put it is an asset sale that it protects the buyer. They're coming in, they're not liable for anything that happened prior to.
Exactly.
So 90+% of what we see is buyers protecting themselves in an asset sale.
Right.
The only time we really see stock sales nowadays is if it's, up over 20 million in enterprise value, or if there's some sort of government contracts that can't be construed.
Right.
So
right. Exactly. I was going to say with clauses and kind of some agreements are already in place. Right. For sure. That's the only reason why you're going to do it. Otherwise, it's going to be an asset sale for sure.
Yeah.
And if that's the case, then the 8594 form becomes super important. You already know that. And I talk about this all the time with people because it's like very confused. I'm like, where's the 8594? We have to
asset allocation.
Asset acquisition. Right. It's just like allocating the assets and how they're done. We want most of it to be goodwill. If we can, you already probably know that's the fixed assets, the inventory, the non-compete, and then the goodwill. And obviously the buyer's going to want most of it in fixed asset and other things so they can depreciate it. The seller's going to want it mostly in goodwill. So it's a kind of trying to keep both parties happy. Most of it's going to be goodwill anyways. And the reason why we want most of it in there is because it's long-term capital gains tax, and the rest of it's ordinary income. Ordinary income taxes are much higher right now. I mean, I'm saying this now in 2024. This might change, right? If capital gains tax rates go way high. So that might change, and we might change our perspective about which ones we want higher. But we're talking about 15-20% on capital gains tax versus like a 37% tax bracket for ordinary income tax rates. Yeah. So we want to keep them in goodwill. So tax planning in that sense. And then, of course, we've got depreciable assets, that kind of thing, adding all of those in there. We want it as cost. And, Inventory is not taxed, so that's just a plain number. Whatever the cost basis is for inventory, if there's inventory. So, and then everything else is goodwill, and hopefully, and that's always the most ideal situation. If you can get that number as high as possible, we can kind of lower the tax. But that's why it's important. Like, a lot of times the buyer will come and be like, "Here's the asset," and people are like, if they're doing it on their own, they're like, "Sure."
Sounds great.
Yeah, but then the taxes are a lot higher. I mean, if you switch those things around, you could really, lower that tax bracket.
Asset allocation is always one of those last minute negotiation pieces that it's theoretically a really small piece. We've already agreed on all the details.
That's all I'm thinking about.
And it's, it's just one page in a 40 to 70 page contract. It's just that one little page that locks it out, but it's the biggest implication for the seller long term. And we always have these last minute negotiations, and it is a panic of ours when we're like, well, all right, asset allocation, this is a big piece. You talk to your CPA about this. You know how you're getting taxed.
I'm always stressed about it when everyone does it, because I'm like, we got to get the goodwill as much as possible, And so it's interesting, though, because sometimes the buyer is not very well versed about those kind of things, and there's just like, whatever you want. And I'm like, amazing, I'll do it. Let me do it. And then I get to do it, which happens quite often, weirdly enough.
It's so, especially in smaller deals. So I think, you and I do a lot of what we would call Main Street deals. I mean, we had one the other day, and it was, just under $1 million, and there's like maybe 200,000 in assets. And the buyer agreed to put the rest to goodwill. Yeah, great. Which is fine, but it's great for the seller, and so
not great for them because they have to amortize it over 15 years. So it's not really that great for them. But when that happens, and they're like, because it looks like it is a tax form. It's a tax form. So they're like, here, you fill it out. I'm like, great, cool. This is gonna. I already know what the tax is gonna look like. I can estimate it. I can plan it. It's great.
How does asset allocation affect a financial advisor standpoint after they actually get the money?
I mean, asset allocation in general, after they get the money, is huge, because what you're doing is you're diversifying your risk, right? And even from a tax standpoint, like for us, it's like control what you can. So we're looking at, like, are you charitably inclined? Does a donor advised fund make sense, right? Or even if we have someone leading up to 3-4 years into a sale, maybe we're harvesting losses to help build up that bucket. For when they do sell, we have these losses to offset some of the capital gains. Right. But then post-sale, the asset allocation is kind of everything, because you have your different buckets. You have your retirement accounts, you have your taxable accounts, and then how much is in private markets versus in public markets. That all depends on their cash flow and what they need. Are we investing for the next 10 to 15 to 20 years for retirement? And are we trying to replace that paycheck where we're creating income? Or is this an account where you want to leave this to your kids? You're never going to touch it. So realistically, we have a 30+ year time horizon if you're in your 60s, because your kids are going to get it. Well, then we're investing very differently, because we're going to go for capital appreciation. And then the goal is, at the end, when you pass, the kids get the step up in basis, which also bypasses that. Then that's where we bring in CPA and also a trust and estate attorney, depending on the size of the deal, to help with making that move as efficiently as possible. Right. So every person is very unique. And that's why the planning comes in so early. And it will change the first year we sit down. It'll change year 2. Something always changes. And what drives me nuts is it's a basic human habit, I would say, is we wait to the last minute to do these things. Always. Because it doesn't come priority. And there's always a triggering event that gets people to, all of a sudden, they want to sell, right? There's a death in the family, divorce, they're moving, and without planning ahead of time for this, it ends up becoming a little more sporadic to what you were talking about. They just come, they have no team. And that could affect the deal.
It is tough because, the reality is 100% of business owners are going to exit at some point. It's a crazy stat, but 100% are going to exit at some point.
Whether they like it or not.
Yeah. And so it is tough when you see these business owners who are unprepared, they have no clue, or the worst thing that we've heard is, I started winding down my business. And you're like,
that's the why aren't you selling it? Especially if it's a good business. Yeah. They're just tired of it. And I'm like, why do we sell it?
That's the worst, is, you have someone in their 60s, 70s, 80s, and they're like, oh, well, 10 years ago, it made $5 million a year. And you're like, no one buys that. No one buys 10 years ago. So, as we hit on mistakes, let's kind of dive into that. What are some of the most common mistakes or issues that you see sellers make prior to a sale from a tax standpoint and a financial standpoint?
Well, one of the most common, there's obviously unorganized books, things like that. We could talk about that more. But I also think people start saying to other people they want to start selling their business. And earlier the question was, when do you tell your CPA or your financial advisor? But also I realized when you were telling that story where you were saying that people are like, I just want to be done. Yeah. They start telling people. Like, let's not tell people because what happens is it just lowers that price because you want to go. Right. And so I think one of my clients did that where they started telling people because they were just done. Yeah. And so they were telling competitors. So by the time they actually went to market, they got lower than what they really wanted because they really had already spread the word that they wanted out. They were just done. They're like, I'm so sick of this. I'm done I'm too old for this, and it was actually a really great business where they could have made a lot of money. So it's like, it's not telling people, maybe keeping that in your back pocket, not complaining about your business, even if it's doing well or bad or whatever. And organized books, we talked about this, lack of preparation, and not having a team together, setting the wrong asking price. And those are the things that maybe, and also waiting too long to sell. If you're doing really well and you're just waiting too long, you're like, keep putting it off. I think those are really common.
So we'll get business owners go, hey, can I get a discount if someone in my network buys it? And my response is, if someone in your network bought it, we have issues. That means you've told everybody
Exactly.
And so we're like, look,
lowers the price.
We can discuss that if it happens, but if someone in your network bought it, we probably have issues. So, so Mike, where are you at with that? What are the most common things you see business owners do?
Top two, which anyone investor even makes, is one, trying to time it. So getting back to what you said, like, but we can grow for another few years or this and that. Trying to time the market, I think. What happened in 2020 was the perfect example of it. What goes on in the political landscape, where interest rates are, where they've been the last 4 years, how they keep rising. You have to control what you can control, and you can't control those outside forces, which can drastically change the timing or the value in your business. So trying to time it is a huge issue. If you're ready to sell and you have your deal team in place, and this is something you want to do, waiting is not a good idea. You start the process because you don't know what's going to happen. The second thing is the people who just try and do it themselves. You need to, not you need to, but there is a value to advice. Okay. And like you said, if you want to sell it yourself, great, but you may not maximize the value that you thought. And that's because there's so many different pieces to the puzzle. You cannot cover all of them yourself. So the do-it-yourselfers always end up selling for less than they should have. Right. And that comes in with a lot of business owners because they're wearing so many hats. They're used to doing everything themselves. So that's where the relationship aspect of this comes in with your clients, becoming the trusted advisor, becoming someone they trust, introducing them to people you have relationships with that you trust. That will build their confidence and help them grow their team.
The other thing is, what we said earlier is the business is too reliant on you. Yeah. Really planning someone else to hire a manager to take care of your stuff is super important. And then also the other thing I was thinking about is staffing issues. If you have staffing issues, I think that looks really bad on a company. Yeah. And so you kind of that. And then also pending litigation. I think when people have pending litigation, they're like, okay, I'm just going to sell. And I'm like, that's not the right time to do that. Like, get that figured out. And
no, we had a transaction in a technology company 2 weeks ago, and buyer submitted his offer. Everything was looking good. 2 weeks in, he got a cease and desist.
Oh no!
On some of the technology he was using, and it instantly dead. If you have lawsuits or something like that, even if the insurance is going to cover it, take care of it, get it cleaned up, get it out of the way. No buyer is going to buy something with pending litigation, or if they do, they're going to so heavily discount it. Just for round numbers sake, if there's the opportunity that you lose $100,000 on that transaction, right, they are going to discount it $200,000 just to be safe. And so it's clean. Get the business clean, right? First impressions are everything, even in business sales.
Well, I would have you even touch on it, but you sit down with a business owner. How is your business structured? No one, like we're talking about getting ready for the exit. Well, how is your business structured? Is it a C Corp or is it an S Corp? And like you could talk more on that, but they don't know the tax implications
Nope.
behind
Yeah.
that. And maybe if you want to give a brief overview on that, but I think that's like, even that, some people don't know, oh, I just, I put in an LLC because it's just what everyone says to do.
Right.
But they don't know from there what to do. And that's where a lot of advice comes in that years in advance.
Right. Right. No, absolutely. And actually, one of my, this has happened several times in my career where someone's bought a building in their business and they're an S corp, and I'm like, what are you doing, man? When you sell this, it's going to be, there's built-in gains tax. I'm like, no. And they were just like, what? I can't just buy a building, not under the S corp. You could buy it personally, buy another LLC, anything else. But and so I'm like, it's a headache when they do sell the business. It's just going to be a whole mess of things. And so I've run across that where someone did that, and then they ended up selling later on, and so we had to kind of unwrap it and unravel it, and it was a big mess. And I'm like, why didn't you tell me this before you did this? And so it was a fiasco. So things like that, doing something, making a big decision like that without having a discussion with somebody else that knows about this stuff is super important.
Goes back to the whole topic of the show. Planning is so crucial and we're talking sometimes multi-million-dollar shifts in the way you planned, or if you planned, or if you didn't. You kind of hit on this. What are some of the differences in a tax implication from a seller, from an asset sale versus a stock sale?
So, the stock sales, obviously that's easier, but it's not great for the buyer. So not very often does that happen. You said it's very rare, depending on what that's easier from a tax, because it's very cut and dry. It's like, here's the amount that's being sold for. Here's your basis in the company. That's it. Here's your capital gains. We can complicate it when it comes to an asset sale because we've got like those buckets we were talking about earlier. So they're all going to be taxed differently. And the way they're taxed, most of them are going to be, the top ones are going to be ordinary income tax rates. And then the last one, which we want most of it to be, is going to be long-term capital gains. Now, obviously, it's more complicated because on the tax return, I have to kind of negotiate it and that kind of thing. But I think one of the biggest mistakes people do is once they do sell, they don't put aside that tax money. So it's really important to like plan and be like, that $10 million is not just going to be your $10 million. We got to put some aside. Obviously, we want to invest it. We want to talk to financial planner. With the financial planner, we'll decide, okay, this portion of it's going to be for taxes. We're going to hold on to this. We're going to pay part of this to the IRS. We're going to keep this and we're going to invest the rest of it or whatever. And so,
even if I go direct to Cabo, I still need to set aside
you got to put somebody aside for taxes. Yeah. Okay. I don't care where you go. The IRS will find you somehow. They're going to get notice that you got that money.
We set up a separate account. We had someone sell last year. They were just an employee in a transaction, and we knew they were going to owe this amount from working with the CPA, and they couldn't control it. They were just an employee, and we just put that amount into a money market in a separate account. It was like, that's tax money.
Right.
Doesn't exist.
That's going out on April 15th. That does not exist.
But I want to make it really clear that people end up doing they're like, oh, I get this and multiply it by 20%. I'm like, no. It's way more complicated than that. There's a whole thing I have to do to make sure that number, it's not just a quick, dry number. Because a lot of times people do that and they'll come up with a number. And I'm like, and my number will be way higher. And they were just like, wait, that doesn't make sense. I'm like, because you have to take this into consideration. You have this, you had this cash, you had, there's just so much other stuff you have to do from the financial side of things to tax plan for what that number is going to be. What other gains you had, the sale of all the assets, everything else. Because there's still going to be ordinary income tax.
Come into play.
Exactly. Right. And then on top of that, any assets because there's still going to be an asset number in there. There's still going to be other stuff in there. There might be non-competes and intangible assets that we haven't even considered. That would be ordinary income tax rates that we have to add on top of that. And so people kind of mistake those two, and they just think they throw a number in there and that's going to be their tax number. And so I think it's really important to tax plan that so we know what that number is and be able to put it aside.
Well, even when the deal goes through, like everyone... You don't want the deal, if you have a massive cap, you don't want the deal going through in December, right? Like if you can control that, like you'd rather the deal go through in January. You have an idea of exactly what your capital gains are. Now we have 12 months to potentially tax loss harvest and find different ways to offset that deal. That is a huge part of what we do too. It's like, well, when's the deal going through? Now you can't always control that exact amount, but year end is kind of tough. And then in the political landscape, is that changing
That's
next
a really
year
good
too?
Point, yeah.
So there's all these other things that come into play that you can't control, but you're given the deck of cards and you got to play the hand that you're dealt. but control the certain things that we can. And if we know that we could have a full 12 months to tax loss harvest and potentially offset some of those capital gains, even if it saves you $5,000 to $10,000 on a tax bill, it's worth it.
No, it's funny. So generally, October, September, November, we get a mad rush on buyers because buyers are on the opposite side of that.
Right.
They're like, cut the check now,
Yeah.
make them cover now before it goes into next year. But we've absolutely had clients that the transaction, come November, it's dead. It's going to sit until the following year so that everyone can prepare. As we get to wrap up here, what are the biggest things post-transaction that buyers need to be preparing for today?
Post-transaction, that's a good question.
So for me, the biggest ones are, what are they actually going to be taxed
on? Right.
That tax is the following year.
Right.
It's not getting taxed. It's not like a lottery and they just take it off out of the side. They actually have to prepare for that.
They have to hold it.
So
That was a great point, Mike, because you could actually just invest it, tax loss harvest, and really plan it correctly, it's interesting because I'm just thinking about like, okay, we got to save up that much money, but you could do other things on the financial investment side to kind of harvest that.
We're always shocked at people who don't bring in their financial advisor of, you're about to have a wealth event. What does that look like for you long term? So what are some of the biggest things you think owners should know and be preparing for today of 6 to 12 months out?
So for older owners, it's very interesting because these are individuals that lived through 2000, 2008, and 2020, where you had these massive market drops, right? So the first thing I always ask when I sit down with the CPA and the client is, do you have any loss carryforwards? Or for real estate people, like you said, real estate investors always have these carry forward losses. So that's the first thing we're addressing, because let's look at that one bucket to see what you have to offset those potential capital gains. That's always a huge factor. The other part is just really the planning behind it. And that is making sure that they have their deal team in place.
Which includes estate planning. With a lawyer. So lawyer is really important on that
side. The
side.
estate planning is huge because the lawyer is going to put together the trust and all the different things. Asset protection, it's also something no one talks about, right? If you sold, you have all these assets, you have a home, let's say you're going to buy a vacation house and your kids are 13 and 17 and one just got their license. Well, you need to make sure if they get in a car accident or something like that, assets are protected in case you get sued. Or if your son or daughter recently got married and there's a divorce, you want to take and play that. So there's a lot of different things on the asset protection side that also come into play that no one really thinks about. And that's where the deal team comes in, because an estate planning attorney is going to ask those questions. Yeah. And they're going to be on top of it.
As we wrap up here, any last minute thoughts or anything else you want business owners to know? Closing statements?
I think we keep harping on just getting a team together. We've forgotten, as we were talking about estate planning, like lawyers are also really important.
Lawyers are huge.
And see structures and just making sure that's right. But whenever we talk about financial advisors or lawyers, I'm just like, put me on a thread. Let's do a call. Like, it's really important to have 3, because even when people are asking me financial advice questions, I'm like, I'm not a financial advisor. Like, let's put the person on the call. And so that's important. And they're saying, I'm not a CPA. I'm not a lawyer. We're all saying the same thing because we're not, those are not our fields, but we know enough to get dangerous. So I think it's important to just have all of these people in place, including along with the business broker, to be able to facilitate the transaction.
I ask people, I try and get them to back into it themselves. Okay. So I'll be like, you sold your business. It's 3 years from now. You couldn't be happier with how it went down. Retirement's going great, this and that. And they go, yeah. I go, what does that look like? So then they back into it. Right. And they give you the idea of what that looks like. And I'm okay. And I'm like, now, how do we get there? What are your strengths? What are you good at? Well, I'm really good at running the company and, keeping the statements in order and whatnot, but I'm a terrible sales guy. So we back into, okay, so you need this, this, and this. Right. And you have them realize by answering their own questions, the need for these professionals in their lives. Right. And that brings the whole team together. And also, we're putting it on the business owners. It's on our side as professionals to also step it up and make relationships with other people that are involved in the deal. So when your clients need someone, your clients trust you. Mari is not going to agree with me on this. The number one trusted advisor apparently right now.
Disagree.
In 2013, according to EPI,
according to I don't know what,
it was a CPA was the number one trusted advisor. As of 2023,
do not believe
the
this.
Exit Planning Institute says the number one trusted advisor is a financial advisor.
Disagree.
Number two, nothing against my lawyers.
Apparently
if they say lawyers are number two,
know.
that
and
one I
number
don't.
three.
And number three is a CPA. But no, the idea is to have these relationships with other professionals, because the most intangible thing you could do as a professional is surrounding yourself with other people that can help your clients.
And it's funny because I tell my clients all the time, I'm the opposite of you. And I don't back them into, I'm just like, you need this. I tell them what to do all the time. Maybe that's why I'm not number one anymore. But
no, it is. So we've dealt with Mari's clients, and I'll tell you, they're like, I don't know. Mari said this. Just ask her. Like, I don't know.
I just tell them what to do. They seem to like that. I don't know.
Yeah. So thank you guys both for coming out today. Thoroughly enjoyed the conversation. If someone watching the show wants to get a hold of you, wants to talk about their CPA, their bookkeeping, any of that, how do they get a hold of you?
My website is maricpa.com, and my email is mari@maricpa.com. If you don't know how to spell Mari, you roll the R. It's Mari.
We'll put a link. We'll put a link to it. Don't worry.
You roll the R though. That's how you roll the R. Mari.
Yes, that's right. I'm Mike McNamee at Dedicated Wealth Partners of Raymond James. That's raymondjames.com/dedicated wealth partners.
Perfect. If you want to keep the conversation going today, if you enjoyed what you heard, you can find us online, social media at Twitter at the EXP Exchange, or visit our website, expertexchange.pro. That's expertexchange.pro, where we will have links to both of them and their resources. But you can reach out to them. Mike and his team is raymondjames.com/dedicated wealth partners. And you can find and connect with Mari at maricpa.com. Okay. So we'll link to both of those, link to their LinkedIn profiles, all of that information. Thank you so much for coming out today. Remember, success is a journey, and we're thrilled to be a part of yours. We'll catch you on the next episode.
Thanks for having us, Josh.
Content on this show is information of a general nature and does not address the circumstances of any particular individual or entity. Nothing in this show constitutes professional or financial advice, nor does any information on the show constitute a comprehensive or complete statement of the matters discussed or the law relating thereto. The Expert Exchange is not a fiduciary by virtue of any person's use of or access to this content. You alone assume the sole responsibility of evaluating the merits and risks associated with the use of any information or content on the show before making any decisions based on such information. In exchange for using the content, you agree not to hold the Expert Exchange, its affiliates, or any third-party service provider liable for any possible claim for damages arising from any decision you make based on information or other content made available to you through the show. The Expert Exchange is not licensed to practice law or provide legal advice. Nothing contained within this show is intended to be an offer to either buy or sell securities.